Picture a building that sits just a few blocks from the White House, a building whose name is carved in stone above its entrance, a building whose seal appears on every single dollar bill in your wallet right now. It is called the Federal Reserve, and for most Americans, that name carries a kind of quiet authority. The word federal doing the heavy lifting, suggesting something governmental, accountable, something public, a piece of the architecture of democracy, like the post office or the Supreme Court or the Army Corps of Engineers. Now picture the moment you discover that the word federal in that name was chosen deliberately, carefully, strategically, not to describe what the institution is, but to obscure what it is. That the Federal Reserve is not a federal agency in the way the IRS is a federal agency, or the Pentagon is a federal agency. That it does not appear on the official list of agencies of the United States government. That a federal court ruled, in language that was as plain as a court can manage, that the Federal Reserve banks are not federal instrumentalities for the purpose of federal tort law, because they are privately owned. And in that moment, a question that sounds simple becomes genuinely strange. If the Federal Reserve is not federal, then what exactly is it? And the question underneath that one, the one that matters even more, who owns it? That question has been the engine of 100 years of conspiracy theories. The theories go something like this. A secret cabal of private bankers, names like Rothschild and Rockefeller and Morgan and Warburg, met in total secrecy in 1910 and designed a private central bank that they then disguised as a government institution. That this bank has been quietly extracting the wealth of the American people ever since, inflating away their savings, financing wars, controlling presidents, and concentrating the money of the nation into the hands of a few extraordinarily powerful dynasties who operate entirely beyond democratic accountability. This version of the story is one of the most widely believed alternative histories in America. It has sold millions of books. It has filled thousands of hours of content across every platform that exists. It has been repeated by figures across the entire political spectrum, from libertarian economists to progressive firebrands, from people who would never agree on a single other thing in their lives. And the reason it travels so well, the reason it sticks, is that it is built on a foundation of facts that are real. The meeting happened, the secrecy happened, the private ownership is real, the names are real. So today we are going to do what almost nobody who repeats that story ever actually does. We are going to read the Federal Reserve Act. We are going to look at who legally owns the regional Federal Reserve banks and what that ownership actually means under the law. We are going to sit in the room on Jekyll Island where the plan was drawn up and meet the men who drew it. And then we are going to find out what is true, what is distorted beyond recognition, and what the conspiracy gets exactly backwards. Because there is something it gets exactly backwards. And that reversal is the most interesting thing in this entire story. Because here is what I will tell you before we go a single step further. The real story of the Federal Reserve is stranger than the conspiracy. The conspiracy is dramatic, but simple. Evil bankers, hidden control, stolen wealth, a puppet government dancing on private strings. The truth is more complicated, and in some ways considerably more troubling, because it describes a system that was designed to be genuinely unclassifiable, that sits in a gray zone between public and private, that was not an accident or a cover-up, but a deliberate political compromise, born of panic and pragmatism, and one that has shaped the economic life of every person in this country for more than a century. Let us begin where all good financial history begins, with a catastrophe. Because without the catastrophe, there is no Federal Reserve, no Jekyll Island, and no conspiracy theory to untangle. The year is 1907. The United States is the largest economy on Earth by industrial output, a roaring continental giant whose steel mills and railroads and oil refineries have outpaced every nation that came before. And yet this titanic economy is operating with a financial system that belongs to the 19th century. There is no central bank. There is no lender of last resort. No institution whose job it is to step in when a bank run threatens to become a national catastrophe. The currency is inelastic, meaning it cannot expand to meet demand in a crisis and contract when the crisis passes. And the banking system is fragmented into thousands of small independent institutions with no real mechanism for coordinating their response to a shock. The economist Milton Friedman described this system with clinical precision. It worked tolerably well in ordinary times and catastrophically badly in bad times. And in October of 1907, the bad times arrived. A failed attempt to corner the copper market sent a wave of panic through New York's financial houses. Depositors, frightened and uncertain, rushed to withdraw their money. Banks that were perfectly solvent on paper began to buckle because they could not liquidate their assets fast enough to meet the sudden flood of demand. The Knickerbocker Trust Company, one of the largest and most respected financial institutions in New York, collapsed in a single afternoon. Its customers stood in lines that stretched around the block, frantic, staring at locked doors, their savings potentially gone forever. The panic spread through the system like fire through dry grass. Banks across the country froze their lending. Credit evaporated. The New York Stock Exchange came within hours of shutting down entirely. The federal government watched, essentially helpless, possessing no tool that was remotely adequate to the scale of what was happening. And then something occurred that should have been impossible for the most powerful nation on earth. The crisis was stopped not by the government, not by any public institution. It was stopped by one man. His name was J.P. Morgan, and he was 70 years old, walking with a cane, and still the most dominant private banker the world had ever produced. Morgan locked the heads of New York's major banks in his private library on Madison Avenue, reportedly with a hand-picked pianist playing softly in the outer room to manage their nerves, and simply refused to let them leave until they had agreed to pool their resources and rescue the failing institutions. He personally guaranteed loans. He personally shamed the reluctant holdouts into line. He served in effect as a one-man central bank, using his own prestige and his own credit to do what no public institution existed to do. It worked. The panic subsided. The economy survived. But everyone paying attention drew the same conclusion. A country of 90 million people and the largest economy on earth could not keep relying on a 70-year-old private banker and his library to save it from financial ruin. Whatever came next had to be built on something more durable than J.P. Morgan's personal authority. That understanding produced Jekyll Island. And Jekyll Island is where this story really lives, because the meeting that happened there is documented, the participants are named, the purpose is understood, and the distance between what actually happened and what the conspiracy claims happened is the whole argument. In the third week of November 1910, 7 men boarded a private rail car in Hoboken, New Jersey, on a night that was chosen specifically for its low traffic. They traveled under first names only. Their luggage bore no identifying labels. When asked where they were going by anyone they encountered, they deflected. Their destination was Jekyll Island, a private resort off the coast of Georgia that was owned by a club whose membership happened to include J.P. Morgan, William Rockefeller, and William Vanderbilt, a detail the conspiracy world finds deeply satisfying, and which is, to be fair, genuinely worth noting. The 7 men who made that journey were not ordinary. There was Nelson Aldrich, the Republican senator from Rhode Island, chairman of the Senate Finance Committee, and the most powerful legislative voice on financial matters in the country. His critics, and he had many, called him the general manager of the nation. His daughter had married John D. Rockefeller, Jr., a fact that his enemies never tired of mentioning. There was Frank Vanderlip, the president of National City Bank, the largest bank in America at the time. There was Henry P. Davison, a senior partner at J.P. Morgan and Company, the institution that had just finished rescuing the American economy with its founder's personal credit. There was Benjamin Strong, who would become the first president of the Federal Reserve Bank of New York, and arguably the most powerful central banker in the world for the duration of the 1920s. There was A. Piatt Andrew, the Assistant Secretary of the Treasury. There was Arthur Shelton, Aldrich's personal secretary. And there was Paul Warburg. Paul Warburg deserves particular attention because he is the intellectual center of the whole operation. Born in Hamburg, trained in European banking, a partner at the firm of Kuhn, Loeb and Company, Warburg had spent years writing papers and delivering speeches that polite Washington largely ignored, arguing with mounting urgency that the United States needed a central bank modeled on the institutions that had given European economies their stability. The Bank of England, the Reichsbank, the Bank of France. Institutions that could provide what America so catastrophically lacked, an elastic currency and a genuine lender of last resort. He understood the mechanics of central banking better than perhaps any other person on American soil, and he had been trying to get anyone in power to listen to him for the better part of a decade. These 7 men spent 9 days on Jekyll Island. They ate together, worked together, and drafted what would become the blueprint for the Federal Reserve System. Frank Vanderlip admitted as much in the Saturday Evening Post in 1935, writing with the candor of a man who no longer needed to be careful. "We were as secretive, indeed as furtive, as any conspirators." He was not exaggerating. The secrecy was genuine, but the why of the secrecy is where the conspiracy theory and the historical record part company so sharply that they are essentially talking about 2 different events. The conspiracy says they were secret because they were hiding a plan to steal control of the money supply for private profit. The historians say they were secret because American politics at that particular moment made open collaboration between bankers and legislators on banking legislation an instant death sentence for any bill that resulted. Nelson Aldrich was so closely identified with Wall Street interests that his name on any financial legislation automatically mobilized opposition. The progressive wing of the Democratic Party, which was ascendant and angry, had made reigning in the money power, their phrase used constantly, the center of their political identity. Any legislation visibly constructed by the men who ran the biggest banks in New York would be portrayed, before a single word of it was debated, as the banks writing the rules that governed the banks, and they would not have been entirely wrong. So the secrecy was tactical, not conspiratorial. They kept it quiet because openness would have killed the legislation before it could be argued on its merits. That is a different kind of troubling than the conspiracy version, but it is the accurate kind. The plan they produced, known first as the Aldrich Plan, was an attempt to build a version of what the Bank of England had been for Britain, a central reserve institution that could provide elastic currency, act as a lender of last resort, and clear transactions across the banking system efficiently. The structural problem was that it gave too much control to the private banking sector and too little to any accountable public authority. When Woodrow Wilson won the presidency in 1912 on a platform built around breaking the power of concentrated finance, the Aldrich Plan was effectively finished. What followed was a legislative battle that the textbooks compress into a few paragraphs, but which was, in reality, a fierce and complicated argument about the most fundamental question in democratic capitalism: who controls the money? On one side were the progressive Democrats, led in Congress by Carter Glass of Virginia and Robert Owen of Oklahoma, who wanted a system genuinely controlled by the government, with no meaningful private banking influence over monetary policy. On the other side were conservative Democrats and Republicans, who were willing to accept a central banking system only if the private banking sector retained meaningful influence over its operations. Wilson, who needed both sides to pass anything, tried to give each faction enough of what it wanted without letting either win completely. The Federal Reserve Act that he signed on December 23, 1913, was the result of that negotiation. And to understand why the conspiracy theory about the Fed exists, why it feels so plausible to so many people, you have to understand the specific shape of the compromise that Act created. At the top of the structure sits the Board of Governors, 7 members, appointed by the President of the United States, confirmed by the Senate, serving staggered 14-year terms designed to insulate them from short-term political pressure. The chairman is a presidential appointee. The board sits in Washington. It is, without ambiguity, a federal government body. This part of the Federal Reserve is as public and accountable as the Securities and Exchange Commission, or the Federal Communications Commission. The people who occupy these seats are nominees of elected officials and confirmed by elected officials. Nobody disputes this, but below the board, the picture changes. The Federal Reserve System is organized into 12 regional Federal Reserve Banks: New York, Chicago, San Francisco, Atlanta, Boston, and 7 others. One for each of the 12 Federal Reserve districts into which the country is divided. And these regional banks are not government agencies. They are, in the language of the law, federally chartered private corporations. They have boards of directors. They have stock. And that stock is owned by the commercial banks in each district: J.P. Morgan Chase, Bank of America, Wells Fargo, Citigroup, and thousands of smaller banks across the country. Every bank that holds a membership in the Federal Reserve System is required by law to purchase stock in its regional Federal Reserve Bank, equal to 6% of its own capital and surplus. This is the fact on which the conspiracy theory stands. Private banks own the Federal Reserve Banks. That is not an allegation. It is the structure of the law, and the names of those private banks are public record. But ownership, in this particular case, means something so attenuated from the ordinary meaning of the word that calling it ownership at all is almost misleading. The stockholders of a regional Federal Reserve Bank do not set interest rates. They do not control open market operations, the buying and selling of government securities that is the primary instrument of monetary policy. They do not instruct the chairman on how to respond to inflation or unemployment. They receive a fixed annual dividend of 6%, capped there by statute. They cannot sell their stock on the open market. They cannot pledge it as collateral for a loan. They cannot transfer it. When a member bank grows, it must buy more stock. When it shrinks or fails, it gets the stock back. The stock is less an investment than an entry ticket to the club. The economists who have studied this arrangement most carefully describe it in terms that should settle the conspiracy's central claim. The member banks own their regional Fed banks, the way residents of a public utility district technically own a share of the utility. The dividend is fixed, the governance is constrained, the ownership confers no real power over the institution's core purpose. The Rothschilds do not own the Federal Reserve. The Rockefellers do not own the Federal Reserve. There is no secret European banking dynasty pulling a hidden lever from a building in Basel or Frankfurt. The stock structure simply does not work the way the conspiracy assumes. Now hold that conclusion, because it is necessary, but it is not the end of the story. It is not even the most important part of the story. Because dismissing the conspiracy does not require dismissing the concern that lives beneath it. And the concern beneath it is legitimate, documented, and considerably harder to argue with than the conspiracy is. The real question, the one worth asking, the one that historians and economists have spent careers investigating, is not who owns the Federal Reserve. It is who shapes it, who staffs it, whose assumptions fill the building and guide the decisions. And there, the answer is considerably more uncomfortable than a simple ownership chart would suggest. Consider the Federal Reserve Bank of New York specifically. Paul Volcker, who chaired the Board of Governors from 1979 to 1987, and who is regarded by most economists as the most consequential Fed chairman in the institution's history, once called the New York Fed the most important financial institution in the world that most Americans had never heard of. He was not being dramatic. The New York Fed is the operational arm of Federal Reserve monetary policy. It is the institution that actually executes open market operations, buying and selling government securities, to implement the decisions made by the board. Its president has a permanent seat and a permanent vote on the Federal Open Market Committee, the body that sets interest rates. And its building on Liberty Street in Lower Manhattan sits within a short walk of the headquarters of J.P. Morgan Chase, Goldman Sachs, Citigroup, and every other major American financial institution. The Board of Directors of the Federal Reserve Bank of New York has, throughout the institution's existence, been populated heavily by figures drawn from the private banking and financial world. This is not a scandal uncovered by investigative journalism. It is a structural feature, written into the design of the system by the framers of the Federal Reserve Act, on the explicit theory that the regional banks needed the practical expertise of the private banking sector to function. Carter Glass, who believed passionately that he was creating an institution to check the money power, also believed that the Fed would need bankers on its boards to understand banking. He was not wrong about that. He may have underestimated what it would cost. What it costs is influence, not conspiracies, not secret meetings, not literal instructions passed from a Rothschild descendant to a Fed chairman. Something far more subtle and far more durable than that. The sociologist C. Wright Mills had a name for this mechanism when he described the American power elite. Not a cabal, not a conspiracy, but a shared class background, a shared set of schools and professional networks and unspoken assumptions about how the world works, that produces a shared worldview before anyone ever picks up the phone. People who went to the same schools, worked at the same firms, sat on the same boards, move between the same institutions, and speak the same language, not because they are conspiring, but because they inhabit the same universe. The Federal Reserve, by design, inhabits that same universe as the private financial sector it was built to oversee. Its senior economists are trained at the same graduate programs. Its staff move in and out of the major banks and asset management firms. Its institutional culture was shaped from the beginning by proximity to the world of finance. And that proximity has consequences. Look at the consequences plainly, because this is where the documented history replaces speculation. In the Great Depression, the Federal Reserve, by its own subsequent analysis, and by the devastating conclusion that Milton Friedman and Anna Schwartz reached in their exhaustive study of the period, made the wrong call at the worst possible moment. Between 1929 and 1933, the Fed allowed the money supply to contract by roughly one-third. Banks failed by the thousands. Credit vanished. The economy collapsed. The institution that existed specifically to prevent a 1907-style cascade of bank failures sat by as the worst financial catastrophe in American history unfolded. Ben Bernanke, at Milton Friedman's 90th birthday dinner in 2002, speaking on behalf of the Federal Reserve, said, "You're right, we did it. We're very sorry. But thanks to you, we won't do it again." It remains one of the most extraordinary admissions of institutional failure ever made in public. Then look at 2008. The banks that had spent years engineering and selling financial products of extraordinary complexity and extraordinary toxicity. Mortgage-backed securities rated AAA that were stuffed with loans that could never be repaid. Financial instruments so opaque that the people selling them often did not understand what they contained. Those banks brought the global financial system to the edge of total collapse. The Federal Reserve's response, under Bernanke, was to rescue them, to extend emergency lending on a scale that had no precedent, to guarantee debts and purchase assets and flood the system with liquidity through programs whose full scope the public would not know for years. And only then because Bloomberg News won a Freedom of Information lawsuit against the Fed and forced the disclosure. When the total emergency lending was finally tallied, it came to $7.77 trillion. The largest single expansion of Federal Reserve support in the institution's history. The banks were rescued. Their executives kept their jobs, and in many cases their bonuses. The homeowners who had been sold fraudulent mortgages by those same banks, in many cases with income figures their loan officers had simply invented, were largely not rescued. 10 million American families lost their homes in the years that followed. The Federal Reserve, acting entirely within its legal mandate, made choices about who to save and who to allow to fail. And those choices aligned with a consistency that challenges the notion of coincidence, with the interests of the financial industry whose representatives sit on its boards and whose alumni populate its staff. That is not a conspiracy theory. That is the public record. And here, finally, is the irony that ties the whole thing together. The irony that the conspiracy misses entirely, because it is too focused on the dramatic version of events to see the actual one. The Federal Reserve was created in 1913, in significant part, to rein in the power of private banking dynasties. The panic of 1907 had made the dependence on J.P. Morgan visible and humiliating. Woodrow Wilson ran for president on a platform of breaking up the money power. The progressive movement that put Wilson in the White House believed, with genuine passion, that concentrated private finance was the greatest threat to American democracy. Carter Glass, who wrote the bill, thought he was building a cage for the banks. What they actually built, in the judgment of many economists who have studied it most carefully, was a set of institutionalized relationships between the government and the banking sector. Relationships of proximity, staffing, shared culture, and mutual dependence that made those relationships permanent, durable, and extraordinarily difficult for democratic politics to reshape. They were trying to build accountability into a system that the bankers had previously run without any. What they produced instead was a system in which the bankers and the government would run together, more or less indefinitely, largely outside the line of sight of the ordinary citizen who would spend a lifetime affected by their decisions. The architecture has produced genuine achievements. The United States has not suffered a bank panic on the scale of 1907 since the Federal Reserve was created. The dollar has served as the world's reserve currency for 80 years. The Fed's response to the 2008 crisis, whatever its distributional failures, did prevent the kind of total monetary collapse that turned the 1929 recession into the Great Depression. These are not nothing. But the architecture also encoded a set of assumptions about whose interests the institution would instinctively prioritize. And those assumptions were never chosen by the public that lives with their consequences. They were chosen by 7 men on a private island in Georgia, modified by a political negotiation in Washington, and then institutionalized into a system that has been running, largely on its own terms, for 110 years. The conspiracy theory says the Fed is a private institution, secretly dressed as a public one, secretly serving a hidden cabal at the expense of the American people. The reality is something the conspiracy cannot quite reach, because the conspiracy is still looking for a villain to name, a backroom to expose, a secret document that will finally explain everything. What the reality offers instead is a structure that is genuinely neither public nor private, that was designed to be neither, that has been shaped by a proximity to private financial power that was not secret, but was also never fully transparent. A structure whose consequences fall most heavily on people who had no say in building it, and who receive, when they try to understand it, either the official reassurance that the Fed is independent and accountable and serving the public interest, or the conspiracy theory that everything is being run by the Rothschilds from a room somewhere in Europe. Both of those stories are easier to live with than the actual one. Both of them have a clear resolution. The official story says the system works. The conspiracy says the system is evil but comprehensible. The actual story says the system is a compromise, designed under pressure by men who were trying to solve an immediate problem with the political materials available to them, and that the compromise has calcified over a century into something that benefits some people enormously, and others barely at all, and that nobody specifically designed it to be that way, and that it is very hard to change, and that the people most affected by it have the least influence over it. That is the story of the Federal Reserve, not a cabal, not a simple public institution, something in between that was always meant to be in between, in a gray zone that the founders of the institution called pragmatic, and that their critics, 100 years later, can reasonably call a problem. The name on the door says federal. The stock certificates say private. The decisions say something more complicated than either. And the consequences say that the question of who the central bank is ultimately for has not been settled in 110 years of operation. Maybe that is the question worth carrying out of this one. Not who owns the Federal Reserve, because that answer, it turns out, is less interesting than it sounds. But who does the Federal Reserve work for? And how would we know if the answer changed? If you made it all the way through this one, leave a single ink pen in the comments, just so I know who stayed for the whole story. If you want history told straight, with the myths stripped out and the evidence laid out honestly, go ahead and subscribe, because that is exactly what we do here, every single week. Thank you for watching, and I will see you in the next one.